So I know the regulatory landscape varies by country, but I would argue as I travel across Asia Pacific, the regulatory landscape that RBI puts in front of you is probably one of the more progressive ones we see. Now in that, if you look at where we started, some of the recent actions that fall within the EFMRS world, continuous controls monitoring basically put us on notice that we need to know that we have controls monitored across a variety of aspects. If you look at some of the biggest AML fines in the Asia Pacific in the last 5 to 10 years, one of their biggest problems and why they got fined, they did not have the controls to know that all the transactions they should have been monitoring were monitored. Then you look at the early warning signals. Early warning signals indicated from the regulator is, I want to know ahead of time whether we're looking at default and the implications it has on others. Now with the more recent legislation around Market Intelligence Unit and CFDT, they're basically saying, I want to understand beyond your internal knowledge of the customer and their activities, tell me the external influencers that might come forward and cause you to have a default and implications on others inside the bank, and arguably using the term off us, others outside the bank as well. I'd argue in some sense, market intelligence is a bit like the dialogue that's happening in Europe around ESG, around understanding the broader ecosystem impacts of what happens from credit default, from banking losses and the like. From my visit here and from my previous visits here, mule accounts is a very hot topic across the region. The reason why? Because that's the way that money from these frauds leaves the system or leaves the country. So in that, mule accounts obviously means I have to inherently look past the transaction. I have to look beyond that individual transaction. I have to look at the activity. We have seen from the regulation from RBI that they've elevated the importance of fraud and AML and put it clearly centered around an operational risk that reports to the Chief Reporting Officer. And I think we've also seen in the recent update about the master directions about fraud compliance, about there again elevating the level of importance this has at the board, at the committee level, and around the linkage that combating financial crimes has around the health of the organization and around the health of the economy. So if you look through all of those, not a whole lot of those are talking about analyzing a transaction. So in that, a dialogue that's happening quite a bit with our conversations now talks about the idea of how do we focus on customer lifecycle monitoring. And in that, they might use the acronym FCLM, and how could I have a presentation without using AI? So I use AI to ask, what is FCLM? So what it says, it's a process of continually evaluating and managing risks associated with the customer's relationship. We just spoke about behavioral profiles. What is a behavioral profile? A relationship, a set of interactions over time. What are the key aspects according to AI? When I asked AI, what is FCLM and what does that mean to the banks? They're saying the key aspects is it is around the life cycle of the customer, from the onboarding activities to ongoing monitoring that might happen from origination of new products to the way they transact. We've heard also the importance of non-financial events and the likes. It's around now the patterns of how people are screening is not a singular event or an international transaction event, and we'll give you examples of that, but also where how data and analytics helps you identify that pattern of the life cycle. What is, to the comments earlier, what is an anomaly? What is abnormal and what is normal? The key benefits, inherently, again, when I asked AI, improved risk management. That's what we're all after, is how do I improve the risks that I'm posed? How do I front to the regulator that I'm adhering to my obligations? And ultimately, how do I improve the bottom line because I'm having less loss? And all those other ones quite logically go with that. So why are organizations saying, I need to look beyond the transaction and look at the customer life cycle and monitor how they interact with us? First, I think front and center through almost every country I visit is scams. If I look at that exit of money as my scam, I am too late. I have to look at how that money was placed. I have to look at how that account transformed it. I am pretty certain that every bank in this room, that if a customer came to you and told you at onboarding, I'm going to be a mule, you wouldn't bank them. They don't tell you that. You have to monitor that through the way that they behave, the way that their life cycle is with you. You have to be able to uncover the chameleon that is there. And that is very important for scams, around how do I identify those participants in the scam, those that have been also scammed as well. Because if it's, again, at the payment level, I'm probably too late to stop it from leaving the institution. Increasing regulatory drivers, obviously we just talked about those. If you look at HKMA have put forward circulars around we need you to bring AML and fraud together, around combating mules and around what they call APS, or authorized payment scams. The expectations are there. Interest in the demand for data, AI and data analytics. There is a level, and a bit to the keynote speaker earlier, is where are we on that hype cycle of understanding what AI can do for us? It is often still, we talk to organizations say, hey, I want to use some AI. Tell me where I could use that. Part of the challenge is actually changing around and making sure you understand what AI can do, but what problems do you want to be better at solving and how AI can help. To the conversation we just had, many organizations are saying, how do I move from detection to prevention? Frankly, the biggest obstacle in a bank is confidence. What I mean by that is if you aren't confident of stopping a transaction, you are likely to annoy your customer, and at what scale are you willing to do that? So moving to prevention means confidence in my detection, confidence in my analytics, confidence in my AI. Focus on collective intelligence. We've heard about artificial intelligence, we've heard about human intelligence. I'd actually argue that still the sweet spot of combating financial crime is empowering the humans that are involved in the loop with the most accurate information in front of them. As I've met banks over the last few days and I've been here, one of the biggest challenges is I've implemented silos of capability and technology, but I don't understand a customer's risk. If I bring that information together and understand that in appreciation of their life cycle, I present that to a user who might interact with that customer, I've brought that artificial intelligence, that system intelligence, that data intelligence, and I've empowered the human. And then lastly, collaboration. Quite a bit of the conversation lately is, well, I only know what's in my box. Arguably, market intelligence units is saying you need to look beyond your unit. The RBI's model for AI, for mule detection, that is looking beyond the organization. If you look at how people are using reference data like BioCatch and threat metrics, that is collaboration. That is taking the insights from many other organizations and how I apply it myself. So again, as mentioned, this isn't just an India thing, and we want to talk through, I'm going to highlight a couple countries. So Hong Kong, those circulars that came out end of last year and earlier this year, the dialogue now is how do I, as now fraud and AML are going to report to the chief risk officer, how do I converge around common problems like scams? The scam reduction expectations from that is you better lift your game and look beyond that transaction. Australia. I do live in Australia, so I'm a bit biased at where that's at. The challenge right now is they've put forward a scams prevention framework, and now the regulator is working through how do I codify that into a set of code. But the reality is they've taken, I would argue, one of the most progressive approaches. Is a scam is not the sole responsibility of a bank. The digital platforms like Facebook and others, they contribute to the scams that occur. The telecommunications organizations, the communications organizations collaborate and participate in scams as well. So their view is the obligation of preventing scams is a whole of ecosystem view. Now, I will tell you, if you talk to the banks, and we had a private roundtable a couple of weeks ago with the banks, they do not believe that all those people will participate equally in that. And I'll give you an example, though, of where that collaboration is already happening. We're also seeing a great deal of focus in Australia around the term perpetual KYC. And in that concept is anywhere during the customer life cycle, could any singular event change the way I view the risk? For that 80-year-old grandma that you banked who never traveled overseas, and you now see travel in international money transfers, are they potentially becoming a mule? Have they sold their account? Are they acting on behalf of their cousin and being a money services business? Are those types of transactional events causing you to reassess the risk that they pose to the organization? And in other geos, as we're probably all familiar, the UK went down a scams reimbursement approach. We're already hearing cases in which now that is co-opting participants into the scam, in which they get a commission back, just like the fraudsters are preying on people to sell their account and giving them $100 or $200 for a mule account. People are saying, if you push forward that authorized push payment and you say it wasn't you, I'll give you 10%. Those things are already happening. Monetary Authority of Singapore, they announced in July last year a $100 million fund for what they call the Collider Project. About how do I bring all this data from across institutions, that collaborative aspect, and develop better insights to save the economy. Their first use case is scams. And as we know, the AI and fintech are changing the mediums, but also focus quite a bit on how do you explain and then the governance around what you're doing in the systems. And I want to share a couple examples of what organizations are doing. So real-time account monitoring was commented out on the panel here too, is you're monitoring the deposits into your account, but you're monitoring the movements to the off-us account as well. If you saw that pattern of beneficiaries, how could you then bring that inside the organization and stop that transaction preventatively before it lands on that external mule account? Perpetual KYC, we are seeing organizations action that basically we're moving beyond the 4 key indicators of a customer risk rating, and any event could trigger a re-rating from any system at any time. Domestic payment screening. Oddly enough, most people have always associated payment screening to international money transfers. One of the largest banks in Australia has said, I want the extra surety, I will screen every transaction that happens domestically as well. Further funding of financial intelligence units. I would argue financial intelligence unit is going to be the stepstone towards market intelligence units as well. Financial intelligence units, sometimes people will call them complex investigations. They are the teams that's being tasked to bring all this data from different siloed systems and start to understand the customer and start to understand the threat that is posed beyond an individual transaction. Many organizations are already using external data, whether that's BioCatch or threat metrics or payphone or phone porting logs. How do I have intelligence beyond my 4 walls without breaching the privacy obligations? If I'm looking at a device or a phone, et cetera, those aren't necessarily personally identifiable information, but they give you a view of a risk that's been posed. We are even seeing, for example, in Australia, if they deem an account is predicating itself towards a mule account, they will impose brute force limits on what transactions they can occur. So organizations are already saying, I'm going to cap crypto account activity to $5,000 or $10,000 a month as a means of brute force saying, I'm not going to let you use that mule account as a means of exfiltration. And then I think there's been much focus around organizations reassessing screening and how are we doing that. The reality is people have kept on adding resources and the false positives have not gone down. How is it that they can understand the customer's behavior in helping drive that forward as well? Now, last couple of slides, and I'll move through these quickly. So how are organizations focusing on actioning customer lifecycle monitoring? One is expand your view of what a transaction is. Move to lifecycle events and understand that non-financial transactions, understand that large sums of money isn't just about receiving money, it might mean a change in their circumstances. What does that impose about the stress that they might be under, or if they had to pay the money and the likes?
Continuous risk profiling. Arguably, behavioral profiles is a version of that. A machine learning model is a version of that. It's how you do those in combination to understand the risk that that customer poses at any point in time. Arguably, if you want to move to prevention, you want to understand the risk that they pose before the action happens. Collective intelligence. I talked about that a little bit earlier. A lot of focus has been spent on, I have all this data, and it was commented about the importance of data. How do I make that data, that system intelligence, that artificial intelligence, usable to the operator that is interacting with the customer or writing the SAR narrative that goes to your regulator? The more you can give them in a single desktop without having to toggle between 8 systems, between spreadsheets of information, the better discernment of the risk posed and the better explanation of why that is a risk. So that's very important in how you engage a customer or how you present your case to the regulator of what you found. Event monitoring, and I think we've talked about it already, beyond knowing what those events are, the day of just looking at transactions is gone. If you really want to get to understand behavior, you need to look at every single event that that customer does with your organization. From the application that was withdrawn, to the information in the application listing income, to the non-financial transaction of changing the phone number that's listed for 2-factor authentication, to the password change, to the addition of a new payee. Almost every single one of those was a non-financial event that indicates a behavior that is predicating fraud. Identity and authentication, as I mentioned, I'm speaking to this to a tax agency tomorrow. They have understood that they thought they put in an identity verification system. What they haven't identified is how to authenticate each interaction, which is different than verifying an identity. So the importance of doing both in combination. So the reality speaking, when we talk with folks around how do you move beyond the transaction, beyond transaction monitoring, and to customer lifecycle and understanding behaviors and how they engage over time, the reality speaking is this isn't something that happens overnight. It is a situation in which how do you smartly combine the 4 key elements of everything that we do, being people, process, data, and technology. I know I'm probably going against the mantra of me trying to sell software to you, but the reality first is start with understanding what you have today and what you can solve with that. But prioritize. The number of times we talk to people that start trying to solve a problem that back to the value of the organization and the risk it poses have not been properly weighted. Where is your biggest bang for buck? Where is your biggest loss? And in that, if you're starting with a problem that is going to hit on all 4 pillars, you just set yourself for a complexity that is going to take months and years to solve. So how is it that you can maybe start in an area that focuses on 2 pillars? Maybe how technology enables 2 of those areas, but how technology is not an inhibitor in doing that. This is oddly one that is often lost when we talk about the organizations within a bank, is be clear on who the stakeholders are involved. You might want to solve the interesting problem, but does the line of business view that as significant a level from the loss basis points to invest in it? Understand their problem and what they're trying to solve. And I hit a button that I didn't mean to. Share the data and AI principles. If you think about it, one of the debates right now is I want to use AI, but how do I govern it? Arguably, other parts of your institution have already been addressing how do I govern models for years, and that's your credit risk area, your model risk management. Arguably, people that are starting to do AML and using models for AML, where are they getting their modelers to do it? They're borrowing the fraud modelers and the customer intelligence modelers and saying, how do I start doing this in the money laundering world? So you're borrowing the principles of data and AI use and analytics use, and you're cross-pollinating that across use cases. Importantly, you only know what you have in your systems, and I think from the conversations earlier about the importance of data and the conversations that I've had with customers, there are still so many silos that exist inside an organization about how do I best use our own data. I would actually say that sometimes it is easier to use external data to make a step change in results. A list of compromised devices that has been contributed to by thousands of organizations across the globe, that might be easier than trying to solve some of your internal data problems. So think about the external data aspects as well. If you haven't already stood up a financial intelligence unit, I would suggest that will probably be the first place that incubates ideas around where bringing data together from my different risk detection silos can help me better understand customers. Arguably, I think when you look at whether it's ESG in one country or third-party risk management in another country or market intelligence here, the principles that you develop from a financial intelligence unit around understanding the insights that data provides you become a logical foundation for how do I bring external data and external influences and how I understand the impact that has on a market intelligence unit. And lastly, I love AI. I'll talk about all the virtues of AI. I think sometimes the challenge, though, is people approach AI as an answer, but they have not defined the problem. So the focus there is figure out the problems that you have that have been challenging to solve and how AI can help solve those. Thank you.